Behind the pristine facades of 18th-century Europe lies a ledger of wealth built upon the labor and resources of the East. The cost of building that global power was pulled directly from the ancestors of modern-day Indians. A private, profit-driven corporation, not the British government, initiated the colonization of the subcontinent. This chart shows the global economy in the 1600s. At the time, India was an industrial powerhouse, producing a quarter of the world's manufacturing, with wealth equivalent to $21 trillion today. Britain, by comparison, was a struggling, developing nation. Their entire economy was a fraction of the size of the Mughal Empire. The events that followed represent a hostile corporate takeover executed on a continental scale. The takeover began as a reaction to shrinking profit margins. In 1599, Dutch traders increased the price of black pepper by 5 shillings, threatening the bottom line of merchants in London. Within a month, 24 London merchants gathered to form a joint stock company. They convinced 125 shareholders to pool £72,000, creating a startup designed to break the Dutch monopoly. On December 31, 1599, Queen Elizabeth I granted the group a royal charter, providing the legal license they needed to enter the market. This charter gave the private East India Company sovereign powers, usually reserved for states. They could now print their own money, pass local laws, and raise a private army to wage war. Armed with these powers, the company operated as an aggressive commercial syndicate, legally authorized to dominate foreign markets by any means necessary. The first attempts to enter India were failures. The Mughal rulers viewed the English traders as insignificant, while established Portuguese rivals blocked their access to key ports. In 1686, an arrogant company director declared war on the Mughals to force better trade terms. The empire crushed the company's forces, seized their factories, and forced the British to beg for their trading rights back. The dynamic changed after 1707. The death of the last strong Mughal emperor shattered the unified state into dozens of independent territories. Instead of direct war, the company used bribery and political manipulation to pit these rulers against one another, slowly expanding their coastal presence. They also benefited from European royal marriages. When King Charles II received Bombay as a dowry from the Portuguese, he handed the territory straight to the company, giving them a fortified operational base. After realizing that direct conflict was bad for business, the company began weaponizing India's internal divisions to secure its foothold. In 1757, the Battle of Plassey effectively served as a corporate buyout of Bengal, India's most prosperous province. Robert Clive used corporate funds from a local billionaire to bribe the opposing army's commander, Mir Jafar, ensuring the company's victory before the first shot was even fired. The company installed Mir Jafar as a puppet ruler. This allowed the board of directors to control Bengal's vast resources without the expense of actually governing the people. This flowchart shows how the company hijacked the economy. Through the Diwani rights, they took over tax collection, tripling the burden on the population. They used those revenues to buy Indian goods, securing inventory for free to ship to Europe for pure profit. The occupation of Bengal was now entirely self-funding. The company had successfully turned a sovereign nation into a corporate profit engine. This extraction model led to human catastrophe. In 1770, a severe famine struck Bengal and Bihar. The company's insistence on high tax rates and grain hoarding turned a poor harvest into disaster. In a region known for its fertility, nearly 10 million people died of starvation. The company used looted wealth to build a mercenary army that eventually reached 250,000 men. They used this force to aggressively absorb resisting kingdoms, including Mysore and the Maratha Empire. They introduced the doctrine of lapse, a legal policy where any kingdom without a male heir was declared company property and absorbed immediately. By 1835, the company's name was stamped directly onto the local currency. They had overridden the existing economy, replacing sovereign wealth with corporate tender. The board achieved total market monopoly by prioritizing shareholder dividends over human life, starving millions to protect the company's stock price. By 1858, the company's corruption and mismanagement led to a major uprising. To stabilize the region, the British government intervened and dismantled the corporation. The Government of India Act transferred all company territories, armies, and subjects directly to the British Crown, turning a corporate venture into a formal empire. This counter represents the scale of the transfer. Economist Utsa Patnaik calculates that over 2 centuries, $45 trillion was drained from the Indian economy. To put that in perspective, the modern GDP of the entire United Kingdom is only $3 trillion. That capital funded the infrastructure of the West. It fueled the Industrial Revolution, paid for the world wars, and served as the foundational wealth for the modern global financial system. Today, the East India Company exists only as a luxury tea brand, recently purchased by an Indian entrepreneur. The foundation of modern Western wealth was built on the most successful and devastating corporate heist in human history.